Good afternoon. Welcome back to Hurdle Rate. For this video, we're going to build a DCF model for Nvidia from scratch. So, looking at the share price, we all know this company's had an incredible run over the last couple of years, going from a low of about $10 all the way up to just, well, 210, and it's now pulled back to about 180. So, what we want to do is we want to basically find the intrinsic value using a free cash flow to the firm model, and we're going to build that on Excel. So let's get into it. One second. First things first, go onto the SEC and also open up a blank Excel spreadsheet. We want the 10K, which is on the third page, the most recent 10K, and that is, it's about halfway down, this one. And on the first page at the top, the latest 10Q. We have them here. So let's let's start. Let's move on to the Excel onto the Excel spreadsheet and start building this DCF model. So the first thing that we need to do is we take off our grid lines, page layout, take off the grid lines, you freeze the first column, then insert another column before that, make the A smaller and the B larger, and type NVDA in cell A1. Then go Data, Stocks, and go for this one, the NASDAQ listed. Okay, what we need to get to about page 41, because the first thing we're going to do is go through the revenue segment. So let's do first write a ticker. I'm going to zoom in a little bit. Ticker, date, then we want the current price, the implied, what our model will tell us the company is worth, and we want to know if there's any up or downside to that. Do a quick bit of formatting. Should be an X, sorry. Go to about M. Fill. We go. And this section is called assumption. And this will allow us to simulate between different scenarios for the revenue segments and the operating, which is the EBIT. The two revenue segments are this one, computer network and graphics. So and up here, put switches. Then we want bear, base, and bull. Just bold them. The next segment is not part of the revenue, but it's the EBIT. It's on the income statement. Then it's WACC, which is the weighted average cost of capital. Then it's your terminal growth value, and we're building this model 5 years out, and so we're saying after those 5 years what we think the company is going to be growing at in perpetuity, and that is usually 2.5%. Okay, we've sort of done the admin part of it now. Let's do the revenue build. And this is basically all we're doing is we're taking, we're just going to sort of write down these figures, but we actually need another, 1 second. sorry, come to page 78 instead, and this is what we want. Because then we have 20 starting with 23, 24, 25. Nvidia's financial year ends at the end of January. So 20 the year that we're currently in for them is 2026. So we're going to keep it how they do that here. So we'll start 2023. I think we forecast out until 2031. When in reality that is for, I guess, the sort of the full year for 2030. But we'll do it how they do it. Yes. So we use this figure here for the full year revenue for these for what we're going to put onto the spreadsheet. So equals 10. And we want to know what the growth of that is. And we know for Nvidia it's going to be huge. And full. And we can put in percentage of revenue if you like. It's not crucial though. I'm going to format this so that it looks how we like it. Go number, no decimal places. We use the thousand separator. Take away negative numbers. We put in brackets. Then, okay, sorry, I forgot to do all of this up here. So ticker, you just go equals A1 dot open the brackets, market cap. So equals A1 dot open brackets, ticker. Go, the date today is the 23rd of the 11th, 2025. The current price equals A1 dot open the brackets, price. And these two we can leave because they will be calculated by the model. In your switches, just leave everything to 2, like that, and we'll sort out the rest later. So compute and networking, we're going to say down here, 2023, 26974. Then 6922, then 130, 497. So you can see that this growth is huge. To work out the growth rate, we take the year that we're looking at, divided by the previous year, minus 1. Put this into a percentage. And again, yeah, it's incredible. So for 2026, remember, 2026 is, we get to the end of the year in at the end of January. 2026, what they would call 2026 covers 2020. So it's a bit confusing, but that's how they do it. So let's just keep it like that, and we can yeah. So wow, they've already, so for the first, in the first 3 quarters of the year, their revenue is already higher than what the total of last year. So if by in the first 9 months of 2024, sorry, for the year of 2025, they made 91 billion. So we take this and we divide it by 91,166. Sorry, divided by, yeah, so it's 1.43. We're going to take this 147,811 multiplied by 1.431428. So they should do more than 200 billion for this year, for this total year. Then we're going to now start forecasting out what we think the next 5 years of revenue is going to be. And we're going to be able to do this using our switch up here that will allow us to go through the bear, base, and bull scenarios. And that way we can, if different scenarios happen, we can have a forecast of the price. So to calculate next year, I doubt it's going to be anywhere near these two. So how should we do this? Let's say it should be, if we say, let's say next year we'll go with 45%. And this, in the final year, we anticipate it being 12%. So put your 12% up in this box, in this cell up here, and then put this cell equal to G10. Now we want to populate these, so it gradually goes to this level. We're saying that at the moment, Nvidia is still the only game in town, so it's still going to have this very high growth rate. But over the next few years, there will be competition. Say AMD gets better. A lot of Nvidia's revenue is generated by about 4 or 5 customers. If they start developing their own, that's not easy to do, but it will chip away at that revenue growth, and it's probably only so much higher it can go. There's no way it can probably sustain these levels, but we'll see. So to work out these three here, we just go equals. You take the previous year, you subtract, open your brackets, take your previous year again, minus your final year, close your brackets, divided by, open brackets, take the final year, minus your this year here, close the brackets. Now we're going to just copy paste this for the next couple of sections. So we need to lock in certain certain elements of this formula, but also leave a bit of it dynamic so it adjusts to where we need it to go. So for this one, we want to lock in the column, but not the row. For this cell, when we use it down here, it needs to stay as the same column, but the row needs to adjust. This cell here will always stay the same, so we lock that in with both the column and the row. Then this last one, we want the column to change, but we want the row to stay the same, so we lock in the row. And then the way we do this, it can do the, but it was going to stretch the column. Percentage, keep it at 2 decimal places. And now what we can do, you just go Control copy and then paste. So the next few years, this is what we anticipate as being the revenue growth rates for Nvidia. We will have, this is the baseline, and this will be the bear, and this will be the bull. We're going to say that the bear case is, let's say it's 90% of these, and the bull case will put it just as 105, because really, I mean, how much higher can it really go when you look at, say, the capacity constraints of, even if the demand is there, Nvidia can only build so many, especially at the same as with TSMC, who I think Nvidia has like 75% of their, I think it's 70% of their production capacity. So yeah, and then obviously the bear cases, these commitments that are coming in don't actually come through. And we saw, say, with OpenAI the other day having something like 1.2, 1.3 trillion dollars of commitments on 13 billion of revenue. So at some point, it's yeah, at the moment that doesn't necessarily make sense. It's hard to see of how it gets there, but we'll see. So you take the baseline and you multiply it by your bear case and lock in the bear case, the cell, because we're going to just pull this across, and we're going to do the same for the bull case. Looks good. Now, when we simulate, these growth rates need to, if we're going on a bear, it needs to show the bear case growth rate, and if it's on the bull, it needs to show the bull case. So to flick between those, and for our switches to operate, we go equals offset, and we take the cell that we're in, G23, the switch, and lock in the switch, comma, and then you put a 0 at the end of it. Formatted so it looks, so it's as a percentage, copy it across. There we have it. Now to calculate the forecasted revenue, you take the previous year and you multiply it by 1 plus your growth rate and pull that along. There we have it. Now we're going to go into the second revenue segment, which is the graphics. Put this equal to B11. Come back here and we're going to take this sorry, I've done the full year revenue for the computer networking. Let's just amend this. This is the figure we need. 15068 47405 116193. Updated for down here as well. So 11906 13517 14304. Onto the other page. Take this 116 divided by 8157, 1.44, and then you do 13128 divided by 1.44956772. Sorry, I forgot my equal sign. Go. Okay, it's fine. Let's do the same for the graphics. $15,983 multiplied by 1.23057. Okay, this okay, so I mean this isn't this one isn't I mean obviously the graphics is nowhere near as what would you call it, as fast growing as the computer networking, which is the data centers. But if we say that this will probably, okay, by this year it's probably only going to be about a 5% revenue growth. So let's put that in. 11. Remember, guys, when you're doing this, you could put your own figures in if you know better, if you've read or you've watched another podcast who said actually this is where they've shown you they're working. Go with that. You don't have to use these figures. These ones I've just sort of, it's more I'm just showing say the method of how to build these models rather than the inputs being well researched basically. So but for the bear case we'll put 95%. The bull will keep it at 105. Change this to 11. Pull it across. Same for the bull. Same for the offset. And to see these switches in action, have a look at the revenue here. If we want to go on our bear case, it comes down. We come back to base, and we can go to the bull case, the more optimistic scenario, and this is what it comes out as. And you just flick between 1, 2, and 3, and that gives you your it allows you to simulate the different scenarios. So you could say, I think computer networking is going to be you're very bullish on that. It's going to do very well, but I think data centers are going to be bearish. And then that can give you different scenarios basically. Let's sum up all of the revenues to get a total revenue. So border, we just put black line. equals sum. Fold it, pull it along. So, I mean, this is incredible. We will be anticipating that Nvidia will start doing more than in $500 billion worth of revenue quite soon. At this growth rate, go. Okay, let's move on to the income statement. The first line of the income statement is always the revenue. We've just built that out, so we just go equals and make sure you always goes equals to what we've just calculated, because we want everything to always be dynamically linked. So if we update this, we want it to be reflected here. Then when we get down to calculating the free cash flow, it's all linked because we link everything to each other. The next one is EBIT, and EBIT is your operating income. After that, taxes. Your percentage of EBIT is basically your tax rate. So we want to come back up to the income statement on both the 10Q and the 10K. So it's down here, but let's do the 10K first because that's for full year. This is here we are. Formatting 4224 32972 81453. So this is incredible. For several years, it was doing about this much in EBIT, for just over 4 billion. Then in 2024, that jumped to over 30, and now it's over 80. So we'll probably end up doing more than 100 billion in operating income, which is, I mean, it's just insane thinking of these numbers. You can't really comprehend it. And taxes, here we are. So in 2023, they received a tax benefit. $4058 11146. So come on to the 10Q now. So where's our operating income is here, 86 billion. In the previous year, they did 57 billion by the same time. So if we take the 81453 divided by 57419, this gives us our multiplier, 1.41857. 86088 multiplied by 1.41857,225, and we know they're going to be doing more than 100 billion, wow, 20 billion in EBIT for the next for the year 2026. Now this is just a placeholder, this one. We just take the average of the last few years, pull that along, take the revenue, multiply it by the EBIT margin, and this will help us sort of understand what we can expect from the EBIT. But we'll do we'll have something that we can simulate different scenarios with the EBIT later on. So let's look at this 13 billion. If they did 11 billion in total divided by 8 billion, gives us a 1.389 multiplier 13,945 multiplied by 1.3897756. Go. Take an average, fill it along, then take your EBIT, multiply it by the tax rate. Have it. Very good. The next section are the cash flow items. These are your depreciation and amortization, your capex, and your change in net working capital. Okay, format this. Go. These are found on the cash flow statement. So you have your income statement, which is where your revenue, it tells you revenue and then everything down to say net. Then you have your balance sheet, which is your snapshot of what the company owns and what it owes at a certain point in time. Then you have your cash flow statement, which is here. And what we want is the depreciation and amortization. We sum these to get the change in net working capital. And then we want purchases related to property and equipment and intangible assets. This is our capital expenditure. So we do the same for so that was on the 10Q. This is the 10K. Let's start with a 10K so that it's so that we're going this way. Okay, so where is it again? 1544. 1508 1864. This is tiny, a tiny amount of revenue. As a percentage of revenue, sorry. Well, before it was 6%, but now look at that 1%. And capex, where is it? This one. 1833 1069 3236. We want that as a percentage of revenue. Sometimes it's good to know what your depreciation is as a percentage of the capex. So change in net working capital, we just sum all of these. So we go equals sum 822, comma, negative 2554, negative 1517, negative 551, 1341, 252. We do the same again, negative 6172. Negative 98, negative 1522, 151, 2025, 514. Again, negative 133, 47, negative 4781, negative 395, 337, 4278, 12. And we want to know what that is as a percentage of revenue. The fact that these are negative means that, well, it's good for cash flow because you'll see when we do the calculation afterwards. So let's just work out the multiplier, 1321. If we take equals 2031 multiplied by 1.410523, do the same with the capex. Where is that? 2159. $758 multiplied by 4984. The change in net working capital. We'll just sum all of these because it's quite hard um, to forecast what it would be for the full year. So we'll just leave it as it is. Two zero two 4204 13. Forecast what they're going to be going out. Average. Multiply it by revenue. Okay. So cash flow wise, even these with these huge capex, I think it's going to be it's going to be a lot. Final section we're building is the actual DCF. So again, we just go revenue. Pull it along. Do the same with the revenue growth. Now we're going to forecast our EBIT using this. Piece this down. Yeah, so we just put this equal to default. It is 13. Equal here, but only pull it up to 2026. We're going to anticipate. I think it's. What should we say? Let's say it's still it's a 59% EBIT margin. It manages to maintain that. This is the revenue and multiply it by the EBIT. Have it. It's too optimistic. I think that's fair. Let's put this one down to 58 instead of 59. Yeah, we'll go with that. Taxes, we do the same. Equal. Pull that again. Pull this up to 2026. Where calculate the margin. So the tax rate. With this. Now we take an average of the last 3 years. Across. Take your EBIT, multiplied by your tax rate. Pull that across. We want to link these together so that as we're simulating different EBIT outcomes, the taxes paid will alter dynamically. So that if we were to put this into the bull case, okay, remember these figures, 175 and 20, just under 25 billion. Let's say we come onto the base for the bear scenario, 166, and it goes down to 23. So that's what we want to do with that. Now, we can calculate our EBR, our earnings before interest, but after tax. Order there. EBR. We only need it for what we're forecasting. So you take your EBIT, and you just subtract your tax. Fold it. Pull it across. Then below, we want the depreciation and amortization effects. Change in net working capital. Just pull these down from what we forecast up here. Order. Okay, now we're in a position to calculate unlevered free cash flow. The way we do that, we go equal. So in this 2027, the first year that we're forecasting out, we take our EBR, we add back in depreciation and amortization because it's a non-cash expense. We subtract the capex, and we subtract the change in net working capital. Because these are negative, they're going to turn positive. There we have it. And we forecast those out. So over the next few years, next year will be about 167 billion in free cash flow, going up to 220, 280, 340, and nearly 380. What we want to do now is work out what the present value of those future cash flows are, because of the concept of the time value of money. $1 today is worth more than $1 tomorrow, and that's due to things like inflation, the risks of those cash flows not actually being generated. So we use our weighted average cost of capital, our WACC, and to do that we need to build it. So open up another sheet. Again, just do your formalities, take away your grid lines. You don't need to freeze the first column, but make the A column smaller and the B column quite large. Again, put NVDA as the ticker. I'll zoom in a bit more. Go data, stocks. There we have it. So what is the WACC? The WACC is your weighted average cost of capital, and it is your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. And the first line item that we need is market cap. To get that, you just go equals A1. And remember to divide this by 1,000,000 so it formats correctly. So Nvidia right now is a $4.3 trillion company. Then we have percentage of equity, but we can't calculate that yet. Cost of equity, we can't calculate that either because we need these three items: the risk-free rate, the beta, and what's the other one? The equity risk premium. Only one of these we know. The other two we have to build out ourselves. So the risk-free rate is your US 10-year. This is Nvidia reports its financials in dollars, so we use the US 10-year as the risk-free rate, and that's 4.068%. Then we want to know what the debt is. The debt we can get because we just look on the balance sheet for the latest one, which is up here. So they have $999 million in short-term debt, then long-term debt is about $7.5 billion. That is just, we just go 999 plus 7468. Correctly. Debt, what's the next one? Percentage of debt and cost of debt. Tax rate. I want to put total here, then whack. Total is just your sum of your debt and your market cap. Then the percentage of equity is your market cap divided by your total. And yes, as you can see, the debt is very, very insignificant for the company. It's such a small part of it. This is a majority equity company. The tax rate, cost of debt, you can find, where's its interest? We look at this interest expense. So we'll just do 186 divided by 3 multiplied by 4 to give us a full year amount, 248. We go 248 divided by our debt. It's about a 3% interest, 3% cost of debt, sorry. Tax rate was on here somewhere. Taxes. So let's go 15.3%. Okay, now let's do the beta and the equity risk premium. To work out the beta, we need to look at the industry that Nvidia operates in, the average unlevered beta for that industry, the revenues for Nvidia in that specific segment. What's the next one? The EV to sales, which can give us a value of that segment. We want to know the proportion, then we proportion. What was the last one? Then we get our weighted beta. So the industry that Nvidia operates in. We'll have a spread. Okay. So we will probably say Nvidia operates in, we'll say semiconductors. Let's see if he does. Semiconductor. We can just use semiconductor, to be honest. There's no point in, so 1.66. 1.66. The revenues equals whatever we have. Go. The EV to sales, let me pull up the price to sales spreadsheet. Filter. Factor 14.65. Meaning the value of this company is your revenues multiplied by your EV to sales. So yeah, it's saying about a 3 trillion. The proportion is 100% because we're only using one industry. And your weighted beta is just going to be multiplied by unlevered beta. Normally, sometimes we have a company that is in 2 or 3 different industries. So we do need to break it down so we can understand the value of each of those revenue segments. But for Nvidia, it's just one. On another, I think I've got a few others that do show that, but when in a future evaluation, I'll find one that has multiple of these so that we can break that down. So the weighted beta is 1.66 equals. There we go. And then the equity risk premium. So we want to know where Nvidia gets its revenues from, the region, the revenues in those regions, the ERP, the equity risk premium, and the weight of those revenues to give us a weighted ERP. We know that revenues come mainly from the US. Actually, no, they don't. I did have a look at it earlier. About 4 or 5 countries, and it breaks it down quite nicely. Obviously, the US is the largest, but oh, this is quite cool. Look how they break it down here. Oh, next time we'll do it. We'll look at that. Okay, so we're going to say, this is a tricky one. Let's read this. So for Taiwan, of this 30 billion, they're saying 80% goes towards US and Europe. So what would that be? 86%? It would be, I think, about 25, more than 25 billion of that would be going to US and Europe. Okay, so for US, it's easy. We know the revenues are 97,759. And the ERP for the US is 4.61%. We don't know the weight yet, and we don't know the ERP. So the next one we're going to do is Taiwan. And let's do it like this. So we're going to take this 3301, we're going to multiply by 0.14. The reason we're doing that is because even though this revenue is going through Taiwan, it's actually for US and European customers. So we want to have the risk reflected on that. So yeah, so let's say 4.4242 billion. Let's look for Taiwan on here. Right. Taiwan, 5.1%. Then The next one, let's do China first. That is 16,617. Risk-free rate is, sorry, your equity risk premium is. They're about the same. We'll just go with the Chinese one, 5.25%. Then other will be 3,134. That we can say that this would be, let's go this one, 6.22 for Europe, Middle East, and Africa. Then we want this US, Europe. We'll do a blended one for that, and we're going to take this 3301 multiplied by 0.86. And the risk that we will put here is, let's just do a blended one of this. So if it's 4.61 for the US, Europe is 5.43. Let's just call it 5. So your revenues divided by the total. Lock in the total. Format this so it's only 2 decimal places. Now our ERP, weighted ERP, is just our ERP multiplied by the weight. We want it as a percentage. Then just do the sum. There we have it, 4.8% as our ERP. Pause. Okay, now we can calculate our cost of equity. The cost of equity equals your risk-free rate plus your beta multiplied by your equity risk premium. So we can take the risk-free rate plus your beta multiplied by the equity risk premium. Maybe just bracket these. Go. Okay. So the WACC now, all we do is go equal, open your brackets, take your percentage of equity, multiplied by your cost of equity, close brackets, add, open brackets, your percentage of debt multiplied by your cost of debt, multiplied by 1 minus your tax rate, then double bracket at the end. There we have it. 12.02%. And it's going to be pretty much the same as the cost of equity because the company is 99.81%. Okay, come back onto the main spreadsheet. We put our WACC in here. And on the bearish case, we take the base and we add on, because the higher the whack, the riskier the greater, the more bearish you are. Same with the bull, but we just subtract 0.5%, give us a lower whack. We're going to say the terminal growth value is 2.5%. The bearish will be minus 0.5% from to get 2. The bullish will be add 0.5%. We go. And we're going to allow us to flick between the switches, instead of using offset function, we use choose. And you just select each of these in the correct order. And that will show, whenever we flick through this, it will show whichever one we're, let's see here, see. Let's copy this down. The same will apply. Now, above your DCF line, just add another row. Put a 1 in at the top of 2027. Do 1, 2, 3, 4, 5 at the top of these, and you'll see why in a second. So we want to calculate the present value of the unlevered free cash flow. We do that by taking the unlevered free cash flow, we divide it by 1 plus your WACC, close brackets, to the power of the year that we're in. Remember to lock in the WACC, because we're going to pull it along. Go. So that's our present value of unlevered free cash flow. Now we want to look at the terminal value, to calculate the terminal value. And this is done by taking the final year of the forecasted free cash flow, multiplied by 1 plus the growth rate, terminal growth value, divided by your WACC minus your terminal growth value. It will come up in a second. In a way, it always takes a bit of time. So PV, so we want the present value of the terminal value, PV of T. Again, this just equals your terminal value divided by, open brackets, 1 plus your WACC to the power 5. So to the power of the final year, which is 5. The next step is we want to know what the enterprise value is. And this is, you just go equal sum. You take the present value of the terminal value and all of these cash flows, present value of the cash flows that we forecast. And we want to add cash back in and subtract debt. We know the debt because we calculated it for the WACC. So just put that equal to there. Then our cash is, let's find the balance sheet again. Here we are. So we can use these top two as cash. So 11,486 plus 49122. The next step is the equity value. And we want to know what the diluted shares outstanding are, which will give us the implied share price. So you take your enterprise value, you add in your cash, and you subtract your debt to get the equity value. The diluted shares outstanding are on the income statement down here. So we're going to go 24542. 4542. So the implied share price is just your equity value divided by your diluted shares outstanding, which would say $135. Which, whoa, let's plug that in. K100. Get the upside or downside, you just take the implied divided by the current minus 1. There we have it. So the base case, it's forecasted about 135. On the bullish side, gets to about 165. The bearish, 107. So, I mean, it's not far off the high, but there's there could still be considerable downside considering I mean, it's not far off what the current price is. But yeah, I think, I mean, the peak was, what was it, 210? It's saying that the fair value is about 135, and I don't think we've been. I don't think we've been bullish nor conservative on our estimates. So yeah, we'll see. I mean, it's not this is not financial advice, but it gives you a good idea of, I guess, roughly whether company, what the value of the company. So yeah, cool. Okay, well, let me know what you think. Please hit subscribe, and I'll see you on the next one. Thanks again, guys. Bye.